Thank you. Thank you. Good afternoon. Good afternoon and welcome to the third session of the Analytical Corners of this year's World Bank Group and IMF Spring Meetings. My name is Sébastien Van Hoek and I work for the Secretary's Department. My colleague Joe will make a presentation on the role of IMF arrangements in restoring access to international capital markets. The presentation will be followed up with a brief Q&A session. Please do not forget to switch your phone back on after the presentation. Thank you, and now join me in welcoming my colleague Joe Kogan. Welcome, Joe.
Good afternoon. Let me start with a question. Why are some countries able to issue bonds to international investors and other countries are not? My name is Joe Kogan, and before I came to work for the Monetary and Capital Markets Division of the IMF, I worked for almost 20 years on Wall Street focusing on emerging market bonds. Part of my job was marketing those bonds to investors, and I want to tell you about one case in particular. We were trying to help a country that had never issued bonds before to international investors to do this for the very first time. And we called an investor. We were eager to talk about this issuance. And to our surprise, the first thing this investor asked us about this issuance, he said, "What continent is that in?" And what do you say to that? How do you market a bond for a country that's completely unknown to some? What we found worked really well is informing the investor that this country was under an IMF arrangement. And that seemed to go a long way in convincing him to buy the bonds. So that experience raises two questions for me. One, can the IMF really help investors in their bonds? And two, if the IMF does help, why does it help? The chart before you shows an empirical analysis we have done on this question. On the vertical axis, you have spreads, which is the cost of financing. And for the purposes of this graph, this is our measure of access to international markets. On the x-axis, you have the number of quarters before or after an IMF arrangement. What we've done here is for 87 arrangements over the past 20 years, we've graphed what happens with spreads around the time of board approval of the arrangement. Following the yellow line, you can see spreads start out at 0. This means whatever is that country's historical mean. Then, as time goes forward, you see a crisis developing and spreads are going up. As approval of the IMF arrangement approaches, spreads tend to stabilize. And then after approval of the IMF arrangement, you see spreads go down, such that 16 quarters after approval of the IMF arrangement, you have spreads coming down by about 45% and recovering most of what they had gained before. So why do spreads do that? Why do IMF arrangements help reduce spreads? There are two possible explanations here. First is liquidity, and second is conditionality. Let's talk about liquidity first. So liquidity here refers to the IMF's role as the lender of last resort. And I think this is something that Lloyd Lavendier explained 15 years ago in Jamaica really quite well.
We run out of money, money. Who are gonna rescue we? IMF, IMF. Every day all we hear is IMF. Government no have no money, so no option no left. But IMF, IMF, IMF.
So let's see if Lloyd is right. Let's see if it's really just about money. And that's what we do in the next slide. So we've divided up those 87 arrangements into two groups here. We have large arrangements as determined by the total size of the arrangement relative to a country's GDP. And then you have the rest, the small and medium arrangements. And the blue and yellow lines show you how these behave separately. So you see this dramatic difference at the end. You see both spreads going up for both kinds of arrangements, but it's really only the small and medium arrangements that help spreads come back to zero, that is, recover to normal times. Whereas for large arrangements, after 16 quarters, spreads remain elevated. Now, of course, that's not to say that large arrangements make things worse. Large arrangements are given when their financing needs are greater. But still, what this suggests is that maybe the IMF is doing something else. If giving more money doesn't help, what else helps? Next, we take a different cut at our data. So we divide up the arrangements into two groups based on what we call whether the arrangement is successful. Arrangement is successful when 80% or more of planned disbursements are given out, or for certain kinds of arrangements if it passes more than 80% of reviews. Here again, you see that spreads go up considerably for both kinds of arrangements, but at the end, it's really only the successful arrangements that tend to reduce spreads completely. And there's this tremendous difference. The amount of spread tightening you see in the successful arrangements is about 3 times higher than in the unsuccessful arrangements. So why is that? It seems like the IMF and bond investors are focusing on similar things. What are those things? What we've done in this slide is look at the determinants of access to international capital markets, and we've listed a variety of determinants, some where you'd expect a positive effect, some a negative effect. What we've done here that is different from other academic research on this topic is we've normalized all of the coefficients by 3-year within country standard deviations. What that means is what can a country reasonably change within the 3-year period of a typical IMF arrangement that would help restore access to international markets? So what do we find? The number one condition in terms of the magnitude is financial conditions. This means global financial conditions which small countries can't affect, but luckily, the IMF's mandate includes providing temporary financing in the event that financial conditions preclude market access, and those financial conditions usually revert quite quickly. Debt to GDP is the second most important factor, and that's something that the IMF focuses a lot on, for example, through its DSA. Government effectiveness, real GDP growth are also important. Here's another way to look at it. Rather than using spreads, now we use credit ratings. And it's widely considered that you need a credit rating of at least B- in order to access international markets. And so we said, let's look at what leads to an upgrade from below to at least a B- rating. And we did this for 55 cases over the last 20 years, and we coded the results. So the number one reason for a rating upgrade is debt reduction. And then IMF arrangements you see are in there as the number 4 factor, occurring 11 times. Let's look at just those 11 IMF arrangements. What's really interesting is when an IMF arrangement leads to a credit rating upgrade, it doesn't appear alone. It overlaps with all kinds of other reforms. So for example, there are 3 cases where IMF arrangements lead to a credit rating upgrade, where there's also a debt restructuring. There are 3 cases where there's an IMF arrangement plus fiscal consolidation. One of those cases involves both fiscal consolidation and debt restructuring. So the point here is IMF arrangements do not work alone, but rather they reinforce reforms and lend credibility to those reforms. Going back to the international investor. He was buying the bonds of a country he didn't know, but he knew that the IMF would encourage certain kinds of reforms that would make debt sustainable for his investment. IMF arrangements, by encouraging those reforms, they help reduce spreads, they provide access to international markets as well. And that's important to know because eventually the country will need to finance its own development and, well, to repay us.
Thank you, Joe. Thank you very much. We can now open the floor for questions. So I have some colleagues of mine walking around with a microphone. So please raise your hand if you have a question. And please also briefly state your name and occupation when you ask a question. So the floor is open to you. No immediate questions. So, oh, one over there. This is a brave young man in the back.
Can you stand up, please? Yeah, sure. Thank you so much.
Hi, my name is Abhishek. I'm a lawyer. I work with the Finternet Labs. We're a non-profit. My question was around the two IMF arrangements that didn't fall within any of the brackets. Can you, given that seems like a place where an IMF arrangement solely helped in all of this restructuring. So could you give a little bit of detail on how that worked and what was different about those two arrangements compared to the 9 others?
Okay, thank you very much for that question. Joe?
Sure. So those two, it was also a case where the IMF arrangement didn't happen alone. It just didn't fit into the major categories. So there were other structural reforms involved that were listed by the rating agencies that the IMF presumably encouraged or monitored in some way.
Okay, thank you. So I open up the floor again for questions. Yes, sir, over there.
Thank you so much. There we go.
Thanks. Kelly Hampel, I'm an investor. Curious to get your reflections on why you felt large programs. I was struck by the chart showing that large programs ex ante tended to have relatively tight credit spreads. Large program then required, obviously, a lot of support from the IMF, and then typically those spreads tended to be sustained wider. Is your view that there was some structural or secular shock to those economies that correlated with the size of the requirement, or what do you think causes that? Thank you.
Okay, thank you very much for that question. Over to you, Joe.
So agreed. If you looked at that graph, you saw large programs had a much larger spread increase before the program, and presumably that's because the crisis was bigger. In addition, the size of the arrangement is determined by the size of the financing needs, and IMF arrangements are supposed to help fill the total financing gap. And so they ended up presumably with a larger arrangement because they had a larger financing needs, but then it seemed that it didn't bring spreads down as far. It does bring spreads down. And so maybe those crises are harder to solve, or there may be other issues going on there.
Okay, thank you very much. One more question over here, sir.
Thank you so much.
Hi, Zafar Parker from the South African Reserve Bank. Related to that question, how do you consider what is a large arrangement compared to a small arrangement? Is it the size? To what metric?
So the metric for that graph was the total size of the arrangement, including any augmentations, was less than 6%, or was more than 6% of GDP of that country. We've tried doing this in other ways as well. So we've tried different thresholds. We've also tried comparing programs with exceptional access versus normal access, and you always get that result.
Okay, thank you very much. I think, are there any more questions? Yes, over here. Gentleman over here.
Daniel Shostakov, National Monetary Fund. You show a nice plot of different factors for spread decrease. So would you say this have implications for IMF program design and conditionality, especially given that we have a review of conditionality right now for like fiscal factors being more important in spread reduction compared to, say, reserve accumulation?
Okay, so the impact on program design?
I think it does. I mean, there is certainly, so all of the factors listed there, I think, are considered in IMF arrangements. And then we found really large differences between the role of some and the role of others. I think in some ways, the arrangements that the factors that do seem important are also ones that the IMF focuses on. So I think this could be useful. I guess a caveat I can point out is we've done this for different time periods as well. What I showed you was the result over the entire 20 years that we analyzed. When we break it up into different time frames, before global financial crisis, before COVID, after COVID, the ranking of these can change a bit. And there's actually more research that needs to be done about why they change and are they changing in a predictable way.
Thank you, Joe. I see you have one more question here up front.
I'm Richard from Ghana. There are some countries which have been knocked off from the international capital market, though they are under the IMF program. So is it the case that the proposed interventions by IMF did not work in those countries?
Okay, so IMF programs which did not result into access to international capital markets, right? Okay. Joe?
So the study is meant to show that IMF arrangements help. We find that on average, they reduce spreads by 45%. For some countries, that may be enough. For other countries, that may not be enough. In addition, there are factors beyond the control, such as, of course, financial conditions. So financial conditions go up and down, and that has nothing to do with what the country is doing.
Okay. We have one more question here up front.
Thank you. I'm Bill Papadakis, investment strategist in the private sector. I have a somewhat related question, which is, what's the counterfactual? So you show a range of incidents where spreads widen, then finally after an arrangement, they come down. What happens in cases where there is no IMF arrangement? Do they explode? Do they stabilize nonetheless?
Okay, cases without IMF arrangements.
I would imagine, you know, the thing that surprised us about the results is there's this hump shape that I showed you, and no matter how we rerun the regression, we've tried it many different ways, we always find that hump shape, right? And it's always centered very close to the date of the approval of the IMF arrangement. And that's what made us confident, not just that spreads go down after an IMF arrangement, which would be kind of vulnerable to the criticism you're suggesting, but the fact that it's always centered on the IMF arrangement made us think that the IMF arrangement is doing something. So we haven't done the analysis you're suggesting of what happens to countries where spreads go to 1,000, where do they go after that? But I imagine that many of them would keep going up, and on average they would keep going up and or lead to a default.
Okay. I think we have time for one more question, and this lady here on the front row would like to speak. Yes.
Okay. Tatiana Pinheiro from Galapagos Capital in Brazil. How can the funds prevent that countries re-entering global markets overindulged in excess indebtedness? How can it prevent that an excess capital inflow prompted by the implicit guarantee of the fund leads to overvaluation of the country and produce a more vulnerable situation for the country than previous the deal? Mm-hmm. Thank you.
So potential impact on debt and continued vulnerable position of the country, right?
It's our belief that debt is a really useful tool to finance development. But as you point out, too much debt we know also causes problems. And I think it's for that reason that the IMF is devoting a lot of attention to supporting transparency in debt reporting, to monitoring debt at risk, as was discussed yesterday, and making sure debt is at sustainable levels.
Okay. I think this session is drawing to a close. Maybe, Joe, if I could ask you, what would be your takeaway for today?
Well, what my co-authors and I found is really quite positive. because the IMF has always operated under the assumption that if they provide a combination of liquidity and conditionality, that will give countries some breathing room to implement needed reforms. And what we found is what's supposed to happen in theory really works. That we really see a reduction of spreads and the restoration of access to international markets after these arrangements, about 3 or 4 years after the arrangement.
Okay, thank you very much, Joe. Now, this is the end of the third analytical corner. If you are interested, you can stay put and follow the fourth and final analytical corner on the rise of the silver economy. But there are many more interesting meetings and events and seminars and press briefings taking place. All information on those you can find on the official Spring Meeting app. So thank you very much and thank you for your attention. Thank you, Joe.
Thank you.